Hey, what's good, family? Talking about the real estate game and how we could partnership up and really take advantage and do some things to build a wealth for the future. So first, I wanted to share this video about really the different strategies of how people get properties. We're not talking about our VA loans. We're talking about other ways, right? So now you hear people. Let me make this disclosure first. There was a big spider over here in my house, and I tried to kill it. I don't think I killed it. So if you see me run, you know why. Or if you see me leave, it's because I'm trying to kill it or I'm running from it. So y'all be on the lookout too. It might have crawled somewhere. So anyway, all right. There's a few ways you hear people all the time, or you may hear commercials or whatever, or you see signs out while you're driving. We sell houses, we buy homes, blah 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 blah. Throughout my research, this is what I've discovered, and this is what I've learned, right? And a few investors that I've talked to, um, is that this is basically how it works. There's multiple ways to get homes without using your own credit, your own money, things of that nature, right? So the most two popular ways are seller finance and subject to. I'm gonna tell you the third way. That's gonna be the way that we're gonna use most likely. All right, seller financing, right? This basically means that the owner of the house, whoever owns the property, they own the property where they owe no more money on the property. So they own the property outright. The only thing they're paying is property tax to the city every year for the house. They do not have a mortgage. So what happens in a seller finance situation is you want to buy the house, right? Instead of you going to get a loan to buy the house, right? So you don't need no loan. You talk straight to the owner, which would be me in this example, and you say, I want to buy your house for $200,000. Then I say, how you going to buy it? You're going to say, well, my credit's not good. You probably won't say that. They probably won't say that, but most people, credit's not good, and um, they can't get a conventional loan, or they don't qualify for any conventional loans, right? So then I say, okay, that's cool. Don't worry about it. I'm not even going to check your credit. You give me a down payment of X amount of money, however much you agree to, and you make your payments directly to me. We can do this several ways. You can do payments as interest only, or you can do you could your traditional, break it down to a certain percentage of principal, another certain percentage of interest comes out. But instead of paying the bank, you would pay me directly, right? And so that's a way that people who want to buy homes can get homes if the owner owns the property outright, and if the owner's willing to work with the potential buyer. So that's way number one. No money. I mean, you know, you don't need a credit check or whatever for that, right? Subject to. Subject to's pretty dangerous stuff, right? Subject to means I own the house, I still have a mortgage on the house, but you as the potential buyer, you say, hey man, uh, I want to take over the deed of the property and move in to the house. So basically how it works is like this. I don't know if you're too familiar with the whole real estate game in general. Hold on, I'm getting a drink. Um, so it's two documents. One is the mortgage that you agree to through the bank and the lender, right? That's a document. You have another document which is through the title company. Basically, is the deed or the history of the property saying that you own it, right? So those two different documents. Your name can be on the mortgage, right? But the name that the actual owner of the property can be totally different. So it's two separate things. So what happens is most people who do this one, it's only maybe 5% of the marketplace from what studies and research have shown, right? So subject to is for people who are really in desperate situation as the home seller. They lost their job, their significant other just died, they don't have the means to keep up with the payments, and they just want to get rid of the property by any means necessary, right? Even risking the fact, well, this is how it works. You take over basically the payments of the mortgage, and you make the payments to the bank instead of me making the payments. So what happens is, as the owner, I will sign you over the deed of the property and say, okay, well, I'm gonna use an example. Here's the deed. I'm gonna sign this over to Mr. Jones. Now, Mr. Jones owns the property. He really owns the property, the house itself. But the mortgage amount, no matter how much is on that mortgage, that's still in my name. So that's why I say this can get really tricky. And as the person buying that house or getting the property that way, you can really mess somebody up. So if you do it like this, subject to, you have to be a real stand-up person, because you can really mess somebody's credit up or whatever. The ironic thing about that is, most people who doing subject to, who are selling the property, their credit's already on the verge of being messed up. So they're trying to get out anyway. So at this point, they kind of don't care about their credit or whatever, because let's say if you go to buy the property as using subject to, right? So let's do the roles reverse. So I'm buying a property subject to from you. And you say, man, just take over my payments. I say, all right, man, how much your payments? Oh, $850 a month. Okay, cool, I got that. So also in the subject to, there's an agreement that says 3 years from now, when I'm able to sell this house, I'll give you whatever you ask for, the selling price, right? So you ask to sell a house for $200,000. I get it from you subject to, meaning I make the monthly payments to the bank. You don't make the payments. You don't worry about nothing. You're supposed to be free of all stress as far as making the payments. So now what happens is, me, I won't, in most cases, I won't live in the house. I'll rent the house out. I'll rent the rooms, or I'll rent the whole thing out to build the equity in the house, to get the mortgage down. Once I get the mortgage down to a certain level, I'll pull out the equity. Or I will sell the house and give whatever money we agreed to the owner. So they said $200,000. I've got the house rented out. The mortgage is going down. Boom, 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 boom. We get the mortgage all the way down to like $80,000 or whatever. I turn around and I sell that house for $250,000, right? I give the owners who I bought the house from after the last in the agreement of 3 years. I say, here's your $200,000. I keep 50, right? That's normally how it works. The messed up part about that is, let's say if I can't find renters for the house, then I'm stuck with the payments. But let's say I can't make the payments. So now the owner of the house, their credit is going to go down the tube. And of course, I'm probably going to get phone calls like, what's going on, what's happening. You know what I'm saying? Blah, 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 blah. That's a long story, but subject to is pretty dangerous and pretty tricky. But that's another way that people buy homes without going to the bank, or without using credit, or without having good credit. You know what I mean? So let's mark that one off. That one's real tricky. I hope that kind of made sense. The third one, though, this is the one. This is what is having a business. I'm just going to abbreviate that. A bus. Having a business, right? LLC, most typical. Having a business, having an LLC, is how you get property, or how you get homes without using your own credit, your own money, things of that nature. I showed y'all that I did create me an LLC for real estate recently. And so, because I have my other home, so I'll be renting it out through Section 8 here probably next year if it doesn't sell by then. So anyway, to do what we want to do as partners within this real estate game, we each need to have our own LLC, right? So to create an LLC, it's pretty simple. All you're going to need is $100, $103 to create it, and that's simple. So basically, how it works is you create your LLC, right? Let's call it Joe Properties LLC. So Joe Mama, Joe goes to the bank and creates a LLC, creates a business account. I'm going to put account with the bank. Now for us, we're going to probably use Navy Federal, most of us, but you create a business account with the bank. So they're going to ask you, it's going to be an application you fill out. You just fill it out as normal, put the business name and blah, 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 blah. It's going to ask you about, do you want to get information about business lines of credit, business credit cards, business savings accounts, and all that. Just mark all of them. Check all of them on the application, right? The main thing, though, is what people are using to get homes without using their own property is buying the house with their business. But this is how they're doing it. So, you want to get a business, I already put business a few times, a business credit card. I'm just going to put CC. A business credit card. Now, you want to get not just any business credit card, because you can open up a business, get a business credit card for $500 and interest rate of 24%. And that's not what we're trying to do. That's not what we want. That's not good strategic activities for the business. What you want is a credit card with 0% APR for 12 months. There we go, 6 to 12 months. And some go 12 to 18 months. 12 to 18 months, interest free. Now remember that. Write that down, matter of fact. You want to get a credit card with 0% interest, 6 to 12 months. Most likely it's going to be 12 months. Some go as far as 18 months, but most likely it's going to be 12 months. Now, how do you qualify for something like that through your business? Well, this is where your personal credit, which some of us already shared that we do have good credit, right? Your personal credit has to be, your personal credit has to be at least 720 credit score. That's going to tell the banks and the lenders of the credit card that this guy is trustworthy because they've done well with their credit. And that's how your personal credit can affect your business, right? But technically, you're not using your personal credit to make this transaction happen. You're just showing them that, hey, this is my personal credit. Now, can I qualify for this? And they're going to say, of course you qualify for this credit card. We're going to give it to you. So, created the business, got the credit card. So, Savalas, how do you get the property? Let me explain. So, this is where I got my, let me go to my calculator, show you some numbers. So, you got a credit card, no interest for a year, and you find a property for, let's say, $85,000. No. Let's say you find a property for $85,000. Let's use 85. 85K. Right? So, you work out a deal with the seller and say, they're asking 85. That's the asking price. That's the asking price. this can get real deep because when you're dealing with real estate, you really care about when you're dealing with um, rent and holding. It's certain numbers you're looking for. So you're looking for a rate of return, which is known as ROI. That's what they call it in the real estate world, ROI. It's a percentage, and you want the percentage to be high versus compared to your CD percent that you would get back. So if you gave a certain amount to the bank in a CD, you would probably get about 3% back. Mutual funds, bonds, and all that. Mutual funds and all that, you probably get about 4%. Your average savings account, you're looking at less than 1%, right? 0.02% or something like that. But in real estate, your ROI in real estate should be always higher. It's going to be definitely higher than that. And I'll show you guys that. Hopefully my phone doesn't die, my calculator. So anyway, they're asking 85,000. So what you do, you got a rental property. Now, the rental property, there's nothing really wrong with it, right? Matter of fact, let's say this is a duplex and it has 2 tenants. Matter of fact, no tenants, just a regular single family, right? 85,000. But you want to buy it at a certain percentage. So you take 85,000 times, you want to buy it for 85%, for 80% of the asking price. So you do that times 0.80. So you will tell them, hey, I'll do 86,000. So you do 86,000 and they agree to 86,000. That's 80% of the asking price, right? So this is what you bought it for. I'm gonna say buy price. You can play with that a little bit. Some people go down to 75%, 75 to 85, but 80% is the minimum, right? So we already know that they're asking for 85. We're gonna do our research and stuff and look at numbers and comps in the neighborhood. But most likely, the house is probably either worth 85, a little bit less, or a little bit more. Not too drastic, right? Anyway, we buy for 85. For 68. But we need a down payment. This is where the business credit card comes in handy. Now, as a real estate investor, I'm gonna put as an investor, you need at least 20% down payment. At least 20% down payment as an investor. That means that you're not living in the property, you're going to rent it out or something or sell it. But you're gonna get it as a down payment for 20% at least. Right? So 68,000 times 0.20, you need $13,600 as a down payment. $13,600. That's your down payment. Well, this is how much you need to buy this property, to get it under contract and everything, right? So, I think I'm going to switch markers in a second. So, where do you get this money from? Your business. Your business credit card limit just happens to be $15,000. So your credit card, I'm going to put B, business credit card, your BCC limit is $15K. So you can buy this property. Your business credit card limit is so high because you have good personal credit, and that translates over to your business. So what you do, you buy the property for the 13.6. Let me write that up here so I don't forget. 13.6. All right, That's 20% down, right? With your business credit card. $13,600. You bought it for 86. I mean 68K, and that was your down payment, and that was how much the house was worth. So now you go to 86,000, subtract 13,000. Phone's dying, 5%. Hopefully this lasts for us. You subtract that, so now you're making payments on 54,000 to $400. That's going to be your mortgage. MRG. That's your mortgage. 54,400 a month. Your monthly payments on 54,400 is probably going to be like, for real, $500 a month, if that. That's going to be your mortgage payment. So all you got to make is $500 a month. That's with insurance and everything, right? You're probably looking at like $500 a month. So what you got to do is now rent this property out. So you're going to rent this property out. It's 3 bedrooms, 2 bathrooms, right? Or 2 bedrooms, 1 bathroom. You're going to rent this property out for, let me backtrack. Your all-in price is this, $54,000. All-in price. So what's going to happen is that's how much you got to all in, because that's how much you got to pay the house off, $54,400. So you're gonna rent the property out for, it's a 2 bedroom, 1 bathroom house. You're gonna rent it out for $1,100 a month to a tenant. $1,100 a month. I'm gonna say renter, right? So now, hopefully my phone acts right, because I'm getting pretty deep into this now. Can't turn back now. Now 1,100 times 12 is 13,200. Times 12 because you're going to charge them that for a year, right? So that's going to be your gross income on this property. 13,200 a month. I mean a year, I'm sorry. Now you're going to have expenses. The property management is 10% of whatever the rent is. So 10% of the rent, we already know, is $110. So you're going to pay $110 every month for property management. Now let's throw in another 100 just for like emergency fund, right? So $210 times 12 is going to give us $2,520. That's expenses. That's your expenses. Now, how you get your rate of return? You subtract your gross from your expenses, which is going to give us 13,200. Take away 2,520. So your total net that you're going to make from this property $10,680 a year. You're going to take this number and divide it. You're going to divide this number, your net, by your all-in price. And that's going to give you, you're going to divide how much you get by how much you owe on the property. And so that's going to give you your rate of return, your ROA, what I talked about, and that's going to be 0.196% which is, you go over twice, 1, 2, your rate of return for this property is 19.6%. Now, is 19.6% better than what you would put in your savings? The 2%, the 4% for the mutual fund, and the 3% from the CD? Of course, you would take 19% every time, right? So, I hope that made sense. I know that was a long video, but that's, and remember, oh wait, I'm not finished. Hold on. So, that was the rate of return, 19% on that property. Now, remember, we use a business credit card to buy the property. We have to pay the business credit card off. So, we know this is how much we're getting total for the year. Now, in order to pay the credit card off, right? Credit card was what? We paid $13,600. So the house was worth $86,000. We bought it for $86,000, but let's say the house was worth. Let me erase this. So y'all got that right? All right. That was the rate of return. The house was worth. We bought it for $86,000, but the house, let's say it was worth $83,000. That was the word. Okay. $83,000. That was the value. All right, that was the value, and we got the mortgage down. We said $1,320, right? $13,200 a month. So we would subtract that from 54. I think we already had that number before, and I lost it. So 54, take away 1320, 13,200. So you take away what you owe on the property, the 54,400. Take away from the total amount of rent you would get, the gross rent amount, which was the 13,200. You take that away. Actually, you would take away the let me do that over. It was a 10,600. That's what you took back. That's what you made. So subtract that. That would give you 43,800. So, and that's from what you owe. Take away 10,600. That's what they paid. So then it's a lot of numbers, man. A lot of numbers. Hold on, give me a second. Oh, you would do. That's when it's the end of the year. So 12 months has passed. That's the much money that you made pocketed in your pocket. But that money will really go to the mortgage, because you wouldn't take the money and put it in your pocket for real, because you're not looking for this money. You're trying to get that principal down. You're trying to get the principal payment down. So this is what it boils down to at the end of the year. So you would do the cash out refinance at this point, right? Cash out refinance would say that, and you get 80% of whatever the house value is. So we said the house was valued at 83,000. You would do that times 0.80, which would give you 66 for. So what happened is, this is how much you owe. This is the property you owe. That's how much you owe. And this is cash out value. That's 80% of the 83,000. That's the cash out value for the refinance. So you would take this number from that number, from what you owe, because what happened is the bank is going to cut you a check for 66,400. They're going to cut you that check, and they're going to pay off whatever you owe on the property. So you owe this much, and they're going to pay that off using this. Take away 43,800, and that's going to leave you with $22,600. $22,600, right? This is cash, tax free, doing a cash out refinance. So remember, you paid $13,600 as a down payment to buy the property. But having somebody rent the property out for a high rate of return, which was at over 19%, getting the mortgage down, doing a cash out refinance, you end up getting this much money back. So actually, you bought the house. Let me see. Actually, you bought the house, you got the house for free. And what actually happens is, in this scenario, you gained $9,000 from that move. So, in actuality, they paid you $9,000 in that year to buy the property that you just got. So how crazy is that? And that's just one example. That's kind of a not far-fetched, but an extreme positive example, just because of the numbers I use. But that's the system, and that's the formula that is how people get money without buying homes. I mean, without using their own credit. And when you use your business to buy the property. So what happens is, basically, at the end of the year, of course, you're going to pay off your credit card with that money. With this money, you're going to pay off the rest of the credit card. You won't owe $13,600, of course, because throughout that year, you will make your minimum payments until you get to the end and do the cash out refinance, which with the extra boatload of cash, you pay off the credit card on the business and you pocket the rest of the money. And that's how it works. No lie. And that's how they doing it. So I know I had like a brain fart in between that whole thing, but that's how you buy a house using your business. Hope that helped. Salute.